Hi guys, it's Stock Curry, and the stock market absolutely tanked on Monday. The reason was because of a major fear that freaked the markets out. In today's video, I'm going to explain what that fear was and where the markets might go from here. So let's get into it! The stock market had its worst day in months on Monday, with the Dow down 1.9%, the S&P down 2.1%, the Nasdaq down 2.5%, and the Russell 2000 down 2%, and the VIX, it was up over 15%. The reason is because interest rates skyrocketed. The 10-year treasury is now back above 3%. And while the market was pricing in a 60% chance of a 50 basis point rate hike in September, the market is now pricing in a 55% chance of a 75 basis point rate hike in September and only a 45% chance of a 50 basis point rate hike. So what is going on? Why did interest rates skyrocket and cause the stock market to crash? Well, there are a couple of reasons for this. Over the weekend, we got news that Russia was shutting down gas deliveries to Europe for 3 days. And this has caused a lot of fears that Russia might just shut down gas delivery completely. That caused natural gas prices to skyrocket. And it wasn't just natural gas prices. Pretty much all commodities outside of lumber rose over the weekend and into Monday. Oil went up, gas went up, wheat went up, everything went up. And as commodity prices rise, what does that do? That increases inflation, which means that amazing 0% month-over-month inflation that we got in July might have been a one-off, and it's possible inflation could rise again in August and rise even further in September. So this caused a lot of fear in the markets. And if inflation continues to go up, that means the Fed is going to have to raise interest rates faster than people are expecting. And that is why expectations for the September Fed meeting coming up in about a month are now for a 75 basis point rate hike instead of a 50 basis point rate hike. That is also why we see interest rates skyrocketing on the 10-year treasury yield, is because people think the Fed is going to have to raise interest rates a lot more than what they've told us so far. Now, keep in mind that Jerome Powell is speaking on Friday at 10 a.m. Eastern Time, or about an hour and a half after the markets open. And this has a lot of people fearful that Jerome Powell is going to be very hawkish, meaning they think Jerome Powell is going to talk a lot about raising interest rates even more in order to fight inflation. The reason for that is what happened the last time the Fed raised interest rates. The Fed raised interest rates by 75 basis points in July, and the stock market rallied. We got 2 quarters of negative GDP growth, putting us officially into a recession, and the stock market rallied. So the Fed believes that the market can handle more 75 basis point rate hikes, and it's no problem for the Fed to continue to be hawkish. Well, this is scaring the markets because, as we know from the technicals, the markets rose way too fast in June and July, and now they have to start coming back down. So this is why the markets tanked on Monday. Of course, it wasn't just interest rates, and it wasn't just commodity prices rising. There is something else that is happening in September that has the markets scared. And that is something called quantitative tightening. You see, prior to 2008, the Fed's only tool to fight inflation was interest rates. They set interest rates at 5%, 2%, 10%, whatever they needed to set them at in order to fight inflation and keep inflation down. But since 2008, the Fed introduced something brand new that they had never done before, and that was something called quantitative easing. And in quantitative easing, the thing the Fed did for the first time in history is they started buying bonds. Specifically, they bought mortgage bonds and treasuries. Now, this had the effect in the bond market as the prices rise because of all the buying from the Fed. This lowers the yield. That is, it lowers the interest rates on mortgages and treasuries. So it had the effect of lowering interest rates above and beyond what the Fed lowering their official Fed funds rate was able to do. Now the Fed is doing quantitative tightening, meaning they're selling off those bond assets. And the sell-off of the bond assets has been accelerating every single month, and it's going to max out in September. What that means is as the mortgage bond prices and treasury bond prices drop because there's less demand from the Fed, that is going to increase yields. As yields go up, that means the interest rates for mortgages and treasuries is going to rise as well. Now, we already saw the housing market take a significant and sharp decline in the number of home sales, the number of new construction builds, and the number of people getting mortgages because the mortgage rates rose above 5%. As the Fed continues to sell off their mortgage-backed bonds, that is going to further increase mortgage rates, and it is going to send the housing market into a significant recession. That is going to have a trickle effect across the entire economy, and we are already seeing that. I'm going to get into some of the other news that came out today where we can see that this recession is getting worse. Earlier today, Ford announced that they were eliminating 3,000 jobs. And keep in mind that just 1 month ago, Ford said that they were eliminating 8,000 jobs. And this is how layoffs balloon and start to spiral out of control. First, Ford said that they were announcing about 850 layoffs in April. Then in July, they announced 8,000 layoffs. Now, just 1 month later, they're announcing another 3,000 layoffs. And this is what happens during a recession. Companies start with small layoffs, like Ford did with their 850 back in April, and then the layoffs get bigger, like they did with 8,000 layoffs in July, and the layoffs also get more frequent, like we have another 3,000 layoffs just 1 month later. And it's not just Ford. A lot of other companies are doing these layoffs where we're getting more and more layoffs, faster and faster, larger and larger numbers. And this is going to very quickly get the job market to stability, as the Fed likes to say. The problem is it's like a rolling train. So as the number of jobs available starts to decline, and as the amount of people filing for unemployment starts to rise, it doesn't just magically stop at this perfect equilibrium. It keeps going a little bit beyond where the Fed would like it to go, and it gets to the point where inflation starts to skyrocket, and the recession starts to get really, really bad. And that is what a lot of people are very, very fearful of right now. And then, on top of all of that, we have a wage growth spiral starting to show up where wages are going up faster than inflation is going up. So it is just an onslaught of fear in the markets right now over rising commodity prices, a rebound in rising inflation, rising interest rates, a hawkish Fed. There are bond runoffs causing higher interest rates in mortgages and treasuries. There are layoffs that are getting faster. There is a wage growth spiral people are afraid of. It is just an onslaught of bad news. Truth be told, the bad news was already there. It's just the markets pretty much ignored it for the past 2 months. And now the market is waking up and saying, uh-oh, all of these problems that we have fundamentally, they're still there. And not only are they still there, they're getting worse. And of course, what the market ultimately cares about, they don't care about the economy or wages or layoffs or inflation or interest rates or any of that. What the market cares about, ultimately, at the end of the day, are earnings. Are company earnings going up? And unfortunately, the answer is no. More than half of the S&P 500 companies, when they reported earnings this quarter, actually lowered their year-end guidance. Only 78% of companies beat their extremely low expectations. I mean, to expect that your revenue is going to go down by 30% and it drops by more than that, that is awful. And of course, these terrible earnings are continuing. Zoom reported earnings after the close on Monday, and they showed that revenue growth slowed to 8%. Further, they lowered their annual forecast. The stock was down over 8% after hours, after having already fallen over 2% on the day. And of course, Zoom is not the only company reporting earnings this week. We have a lot of other companies that are reporting earnings, including Macy's, XPeng, JD, and Dick's, all reporting Tuesday before the open. And then we have Intuit on Tuesday after the close. And then Wednesday before the open, we've got Petco, we've got RBC. Then Wednesday after the close, we've got NVIDIA, Salesforce, Snowflake. And then Thursday before the open, we've got Peloton, Dollar Tree, Dollar General. Thursday after the close, we've got Affirm, Marvel, Ulta, Dell. I mean, this is continuing to be a pretty big earnings week, even though none of these companies by themselves are large enough to move the entire market. So you can expect the stock market to continue to be volatile and want to go down for the rest of this week going into Friday. Essentially, it looks like the market wants to sell off going into the Fed speech on Friday. Now, once Jerome Powell speaks, we'll get a little bit better clarity on where he sees interest rates going over the next few months. And that is when the market will kind of make its decision on which way it wants to go for the next month up until the next Fed meeting. Just keep in mind that Monday's sell-off, in my mind, was a little bit too much. So I would not be surprised to see the markets rise on Tuesday in a little bit of a relief rally from Monday's major sell-off. All right, that's going to do it for the market news. I want to remind you that you only have a few days left to sign up for Moomoo and Webull and get up to 25 free stocks. With Moomoo, you'll get up to 13 free stocks. You'll get 10 free stocks if you deposit $100 or more, and you'll get 13 free stocks if you deposit $2,000 or more. You have to use my link in the description below in order to take advantage of that offer, and you have to get your funds deposited before the end of this month. After the end of this month, that promotion is gone. And then, in addition to those up to 13 free stocks on Moomoo, you can also get up to 12 free stocks on Webull. Now, Webull does a little bit more of a lottery system. On Webull, it's going to be anywhere from 6 to 12 free stocks, just depending upon how lucky you are. With Webull, you just have to deposit $100. Again, you do have to use my link in the description below if you want to get up to 12 free stocks with Webull. If you open accounts and deposit funds in both of those, you will combined get up to 25 free stocks. But once again, it all ends at the end of this month. You only have a few days left to get your account open and funded. All right, guys, I hope you got a lot out of this video. Don't forget to hit the like button and subscribe. And if you're on YouTube, click the bell icon and click all so that you can get notified when I release my next video. I hope you have a lot of success trading, and I will see you tomorrow.